How to choose the right mutual fund for your goals. What's up, X100% fam? Eddie here, back with another episode designed to help you level up your financial game. Today, we're tackling a topic that can seem intimidating, but trust me, it's totally conquerable: choosing the right mutual fund for your goals. You know, I get it. The world of investing can feel like you're trying to navigate a foreign country without a map. There's jargon flying everywhere, acronyms that sound like alien languages, and enough options to make your head spin. Mutual funds are no exception. I remember when I first started getting serious about investing. I was working a decent job, finally had a little extra cash, and knew I needed to do something with it besides let it rot in a savings account. So I opened up a brokerage account, feeling all grown up and responsible, and then I was hit with a wall of mutual funds. Hundreds of them. Each with a fancy name, a confusing description, and a performance chart that looked like a roller coaster. I spent hours trying to figure out what the heck I was doing. I read articles, watched videos, and even tried to decipher the prospectus, which, let's be honest, is written in a language only lawyers understand. I felt completely lost and overwhelmed. I almost gave up entirely. But I didn't give up. And neither should you. Because choosing the right mutual fund, while it might seem daunting, is actually a pretty straightforward process if you break it down into manageable steps. And that's exactly what we're going to do today. The very first thing, and I mean the very first thing, you need to do is define your goals. This is non-negotiable. It's like trying to drive somewhere without knowing your destination. You'll just end up wandering aimlessly. Examples of goals: 1. Retirement. This is the big one for most people. But even within retirement, there are different levels of specificity. Are you aiming for a modest retirement, living frugally and enjoying simple pleasures? Or are you picturing yourself jet-setting around the world, sipping cocktails on exotic beaches? The more specific you are, the better you can tailor your investment strategy. 2. Down payment on a house. This is a shorter-term goal, typically 5 to 10 years. You'll need a more conservative approach to protect your capital. 3. Education for your kids, another important goal. Consider the age of your children and how many years you have until they'll need the money. 4. Starting a business. This is a riskier goal as it's tied to the success of your business. You might need a more aggressive investment strategy to reach your target. 5. General wealth building. Maybe you just want to accumulate wealth for the sake of having more financial security and freedom. Even this requires a specific target amount in mind. Don't just say, "I want to retire comfortably." That's too vague. Try to estimate how much you'll actually need to retire comfortably. Talk to a financial advisor, use online calculators, and factor in inflation. Having a specific number in mind will make it much easier to determine how aggressive you need to be with your investments. Okay, so you've got your goals defined. Now let's talk about risk tolerance. This is arguably just as important as defining your goals. It's about understanding how much you're willing to potentially lose in exchange for the possibility of higher returns. Think of it like this: investing is like riding a roller coaster. Some people love the thrill of the drops and loops, while others prefer a gentle ride on the carousel. Your risk tolerance is your preference for the type of ride you're willing to take. Levels of risk tolerance: 1. Conservative. You're primarily concerned with preserving your capital. You're willing to accept lower returns in exchange for minimizing the risk of losing money. You might be close to retirement or have a low tolerance for stress. 2. Moderate. You're comfortable with some fluctuations in your investment value. You understand that there will be ups and downs, but you're willing to ride them out in the hopes of achieving higher returns over the long term. 3. Aggressive. You're willing to take on significant risk for the potential of high returns. You have a long time horizon and can afford to weather market downturns. There are several ways to assess your risk tolerance. You can take online quizzes, talk to a financial advisor, or simply reflect on your past experiences with investing. How did you react when your investments lost value? Did you panic and sell, or did you stay the course? Like I mentioned earlier, when I first started investing, I thought I was super aggressive. I was young, ambitious, and thought I knew everything. I put all my money into high-growth tech stocks, convinced that I was going to get rich quick. And then the inevitable happened: the market took a dip. And not just a little dip, a big dip. I watched my portfolio shrink day after day, and I started to panic. I couldn't sleep, I was constantly checking the market, and I was consumed with anxiety. Finally, I couldn't take it anymore. I sold everything at a loss, vowing never to invest again. That experience taught me a valuable lesson: knowing your true risk tolerance is crucial. It's not just about what you think you can handle, it's about how you actually react when things get tough. Alright, goals and risk tolerance sorted. Now we get into the fun part. Mutual fund types. Mutual funds are basically baskets of investments. Instead of buying individual stocks or bonds, you're buying a share of a fund that holds a diversified portfolio of assets. This helps to reduce risk, as you're not putting all your eggs in one basket. Types of mutual funds. 1. Equity funds, stock funds. These funds invest primarily in stocks. They offer the potential for high returns, but also come with higher risk. There are different types of equity funds, such as large-cap funds, investing in large companies, small-cap funds, investing in small companies, growth funds, investing in companies that are expected to grow rapidly, and value funds, investing in companies that are undervalued by the market. 2. Bond funds. These funds invest primarily in bonds. They offer lower potential returns than equity funds, but also come with lower risk. There are different types of bond funds, such as government bond funds, investing in bonds issued by the government, corporate bond funds, investing in bonds issued by corporations, and high-yield bond funds, investing in bonds with lower credit ratings. 3. Balanced funds, hybrid funds. These funds invest in a mix of stocks and bonds. They offer a balance between risk and return, making them a good option for those with moderate risk tolerance. 4. Index funds. These funds track a specific market index, such as the S&P 500. They offer low cost and diversified exposure to the market. 5. Sector funds. These funds focus on a specific industry, such as technology, healthcare, or energy. They offer the potential for high returns, but also come with higher risk, as they are less diversified than other types of funds. 6. Target date funds. These funds are designed for retirement savers. They automatically adjust their asset allocation over time, becoming more conservative as you get closer to retirement. Example scenarios. 1. Retirement long time horizon. If you're saving for retirement and have a long time horizon, you might consider a mix of equity funds and bond funds weighted more heavily towards equities in your younger years. As you get closer to retirement, you can gradually shift your asset allocation towards bonds to reduce risk. 2. Down payment short time horizon. If you're saving for a down payment on a house in the next few years, a bond fund or a balanced fund might be a better choice. You want to protect your capital and avoid taking on too much risk. 3. Aggressive growth. If you're young and have a high risk tolerance, you might consider investing in a sector fund that focuses on a high growth industry, such as technology. But be aware that this is a higher risk strategy. Now let's talk about fees. This is where a lot of investors get tripped up. Fees can eat into your returns over time, so it's important to pay attention to them. Types of fees. 1. Expense ratio. This is the annual fee charged by the fund to cover operating expenses. It's expressed as a percentage of your investment. For example, an expense ratio of 0.5% means that you'll pay $5 for every $1,000 invested. Look for funds with low expense ratios, ideally below 0.5%. 2. Load fees. These are sales charges that you pay when you buy or sell shares of the fund. There are different types of load fees, such as front-end loads, paid when you buy shares, back-end loads, paid when you sell shares, and level loads, paid annually. Avoid load fees if possible, as they can significantly reduce your returns. 3. Transaction fees. These are fees charged by your brokerage for buying or selling shares of the fund. Some brokerages offer commission-free trading, so look for those options. Practical tip. Websites like Morningstar and Yahoo Finance provide detailed information on mutual fund fees. You can also find this information in the fund's prospectus. Okay, you've defined your goals, assessed your risk tolerance, understood the different types of mutual funds, and are aware of the fees. Now, how do you actually choose a fund? This is where the rubber meets the road. This is where you put all your knowledge into action. 1. Research. Use online resources like Morningstar, Yahoo Finance, and Bloomberg to research different funds that align with your goals and risk tolerance. Look at the fund's investment strategy, historical performance, and fees. 2. Compare performance. Look at the fund's historical performance, but remember that past performance is not necessarily indicative of future results. Don't just focus on the short-term returns. Look at the long-term performance as well. 3. Read the prospectus. This document provides detailed information about the fund's investment objectives, strategies, risks, and fees. It's a long and dense document, but it's important to read it carefully before investing. 4. Consider diversification. Choose funds that invest in a variety of different companies and sectors to reduce risk. Don't put all your eggs in one basket. 5. Start small. Don't feel like you need to invest a huge amount of money right away. Start with a small amount and gradually increase your investment over time. This will allow you to get comfortable with the process and learn more about the fund. 6. Rebalance regularly. Over time, your asset allocation may drift away from your target allocation. Rebalance your portfolio regularly to bring it back into alignment. It's okay to feel overwhelmed at first. Investing is a journey, not a destination. There will be ups and downs along the way. The most important thing is to start, to learn, and to stay the course. Don't be afraid to ask for help from a financial advisor if you need it. Alright, X100% crew, let's recap what we've covered today. We've gone deep into the world of mutual funds, and here are the key takeaways. 1. Define your goals, know what you're investing for. Be specific and set realistic targets. 2. Assess your risk tolerance, understand how much risk you're willing to take. Be honest with yourself about your comfort level. 3. Understand mutual fund types, know the difference between equity funds, bond funds, balanced funds, index funds, sector funds, and target date funds. 4. Pay attention to fees, look for funds with low expense ratios and avoid load fees. Fees can eat into your returns over time. 5. Do your research, use online resources to research different funds and read the prospectus. Knowledge is power. 6. Start small, don't be afraid to start with a small amount. Get comfortable with the process before investing a lot of money. 7. Rebalance regularly, keep your portfolio aligned with your goals and risk tolerance. So, go out there and start exploring your options. Don't let fear or overwhelm hold you back from building a brighter financial future. Investing is one of the most powerful tools you have to achieve your financial goals. And that's it for today's episode of X100%. I'm Eddie, and I hope you found this helpful. If you did, please subscribe to the podcast and leave a review. It really helps us reach more people. And as always, thanks for listening, and I'll catch you in the next episode. Stay hungry, stay foolish, and keep investing.